And Rodrigo, let's just dive into some areas of risk. We spoke about when things fell apart in '08, which was, of course, a very sharp market drawdown. Sorry. So, how does this strategy tend to react in periods of market drawdowns?
Well, it depends on the strategy. So there's a couple of ways to think about this. And Jason Josephiak of Makita, he's no longer there, but he put together an interesting framework in terms of alpha. And, you have three layers, which is first responders, second responders, third responders. And I think a lot of what Keith has been discussing has been kind of a third responder type of approach, which means what is first responders is if the S&P 500 or your beta goes down aggressively, they're going to immediately provide offset. These are the tail hedging strategies, the black swan protection protocols, and the long volatility type strategies. The second layer, kind of to what John was alluding to, is more of the trend following systematic macro strategies, more trend following systematic macro, where if the trends have been in line with equities and there is an abrupt shock, they're not going to be the first responders. They're going to take a week or so to get out and start making money. 2020 is an example of that. First week down, then flatlined, then started providing value near the tail end of that drop. So understanding the time frame for those and what you want to do, what you want that alpha to do for your portfolio is super crucial. And I think the third responders are just zero correlation, consistent zero correlation, where we're not taking directional bets at any time. And when you have that area properly created and you create a multi-manager approach, the goal there is to have a completely idiosyncratic equity line that tends to make money over time, whether it's a market crash or not. It doesn't mean that at any given day that third responder isn't going to lose at the same time as equities, but it's not because of the equities that they're losing. It's just the random nature of a completely idiosyncratic return stream. And if you put these together, and you get a Sharpe ratio of 1, over a period of months, you should have an upward sloping equity line most of the time, right? So the third ones are not necessarily there to fill in the gap in case of an emergency, but if done correctly, it won't hurt you either, right? And so this is the way I think, I love the framework. I think when you think about portable alpha, you should think about what your values are, what you need it to do for you. And there's a wide variety of people that will only do trend because they just want that protection over a full bear market. There are some people just want tail, and there are people that just want to have that froth, that excess alpha most years, which is what you get with a diversified third responder portfolio that you may not get from a trend follower, where it can go through a lot of years of choppiness, but then you get all of those returns when things hit the fan. So I think that's an interesting way of thinking about risk and portable alpha and the different buckets that you can think of. Obviously, I'm a big fan of the combination of all.